Time now for hot picks, and we're zeroing in on 3 plays in the industrial sector. Our next guest has Secure Waste as his top pick. The leading waste management and energy infrastructure company operates primarily in North America, focusing on sustainable waste solutions and energy services. For more on this, I'm joined by Ian Gillies, Managing Director at Stifel. And Ian, thanks very much for joining us. Let's get right to it. Secure Waste is off the top. Number one for a reason, I guess?
Certainly. When you think about where we are in the stock market today, there's an elevated risk of concern in and around AI disintermediation, how it's going to impact people-centric businesses and blue-collar or white-collar businesses, excuse me. And we think Secure stands out from this pack because it has what is largely an irreplaceable network of assets in Western Canada that removes and helps clean up oil field waste. We think one of the interesting things about this stock in particular is that there's really only 2 players that do this in Western Canada. That creates a very strong operating environment for the company. And because of this, what you have is the ability to move prices up 3 to 5% every year, alongside the ability to benefit from higher waste volumes. Western Canada production grows at roughly 2 to 3% every year. And then the other important aspect for this business is that it's an integral player in water disposal and dealing with some of the ongoing water production in Western Canada. And so because of all of this, the company is growing its EBITDA at roughly 7% a year. But the more interesting thing for us is that the company converts roughly 50% of this EBITDA into free cash flow, and it doesn't need to invest a whole lot of capital back into the business. And so as a result, it's growing its dividend. It recently just started doing that again. It is able to buy back quite a bit of stock. We think they could buy back anywhere from 3 to 5% of their shares this year. And then it's also moving well through a consolidation strategy of rolling up metals or scrap steel businesses throughout Western Canada. And that's an important business because you're seeing a proliferation of electric arc furnaces being built in North America. And so the combination of these items lead us to believe we think investors are going to start moving back to old world businesses. And this is the one with all the financial characteristics you'd like to see.
And does it have any expansion plans right now? I mean, you say we just meant Western Canada, but is it looking beyond that outside of North America?
It's primarily a Western Canadian business. They're adding to their asset base in and throughout Western Canada. There's always small bolt-on projects. I believe there's been some looks at U.S. assets in the past, but it's a very different operating environment, and there's more than enough growth to be had in Canada at this time.
There is. So you do think there's room for it. Any challengers, or does this have a moat?
There's a very real moat. When you think about the facilities this company's built in Western Canada, the last one was built in 2014. They were costing, call it anywhere between around $35 million then. We think these facilities could cost anywhere from $50 to $75 million now. And we don't believe there's access to capital to build these, nor demand. So we don't believe that they can be replaced in any way, shape, or form. Okay,
let's get a couple more in here. Badger Infrastructure Solutions. They do the shovel-less digging, right?
Yeah, Badger's once again a pretty interesting business right now. They do non-destructive excavation. So if you were digging a hole in your backyard and you didn't want a line strike, these guys, their trucks would make sure that doesn't happen. Now, that's not what they do. The focus for Badger is largely on large industrial and commercial projects, and they're about 90% U.S. focused, and they're benefiting from a number of tailwinds in the U.S. Number one being an increase in infrastructure-related spending through the IIJA and the like, but there's also a very, very strong benefit coming from AI and data center development. This is about 8% of their business now. And when you think about the power and utility needs, with Badger being the largest hydrovac company in the US with a coast-to-coast network, they should very clearly be a winner. One of the interesting things for me about this stock over the last month or so is that it has traded off around concerns in the first half of the year that margins won't be going quite as fast. But we think people are looking at this the wrong way. they're investing in their business through the next few quarters because they see a rapid growth wedge coming in the back half of next year and into 2027. We think we're going to get verification of this later this week through a higher truck build program than the market's expecting. And so we think this one's going to be a real winner when we look out 12 months from now.
Okay, and last but not least, WSP.
Yeah, WSP has been a very interesting stock this year. It has suffered at the hands of this AI disintermediation trade. We believe the baby's been thrown out with the bathwater on this stock in particular. When you think about engineering, it is drastically different than something like software. And because engineers tend to operate in the real world, we actually thought the CEO of WSP made a very interesting point last week on their conference call, and that engineers are deterministic rather than probabilistic like AI. And when you think about that, as you're building bridges, looking at soil, doing the things we use every day, you need a determinate answer and not the best probability, because we can't have these assets fail. It's going to take some time for the market to sort out the wheat from the chaff related to these businesses, but we do believe that the company's long-term consolidation story, the spending trends we're seeing out of governments globally, are going to continue to drive solid fundamentals. And so with the stock trading at, call it roughly 18 times earnings right now, we don't think you get very many chances to buy businesses of this quality at this sort of multiple.
Okay, we'll wrap it up there, Ian, but thank you as always for joining us.
Thank you.
Ian Gillies is Managing Director at Stifel.